Good day, students. Today we are going to study about business finance decision making technique, and particularly our topic will be payback period. Last time we talked about a decision technique in finance management which is called net present value. So this is the second tool in capital budgeting. No, we are referring to capital budgeting, and if you are just new to this channel, you may go back and watch that tutorial video about decision making technique in net present value. Particularly for today, we are going to discuss payback period. What is our learning outcome? At the end of the lesson, student will be able to compute the payback period on different categories, like for example, uniform cash flow, non-uniform cash flow, payback reciprocal, and payback period using discounted cash flow. And of course, again, since this is a capital budgeting decision technique, we are going to identify and analyze the decision making process. Let's start. So you can see here that this particular payback period, one is a uniform, the other one is non-uniform cash flow. Let us explain this in a layman's term. As a review of facts, right? If this is the company, what goes out of the company are called investment, and they are also called expenditures or expenses. So since it's going out of the company, the symbol is negative. Contrary, if the cash flow is going in terms of profit, in terms of income, in terms of revenues, so it is going inside the company. So what is the sign, students? Let me hear. There you go. Very good. So that is a positive sign. And you call this cash flow as cash outflow. And you call this cash flow going in as cash inflow. All right. So now we are on the same page. Let us erase some notes. Moving forward, so in this payback period, you can see that we have to learn the different computations of a uniform cash inflow. This is inflow. And on the right side, there is a computation for non-uniform cash flow. So the cash flow we are referring here are cash inflow. Meaning to say, on a particular year or a particular number of period, whether it be 2 years, 3 years, your cash inflow are not similar on a particular year. While on the left side, your cash inflow is uniform. Okay? Example. Okay? Example. We have on the first year, we are talking of uniform, huh? Okay. On the first year, you have a cash inflow of 30,000 pesos. Okay. On the second year, since it is uniform, therefore it will be 30,000 again, your cash inflow. And on the third year, it is going to be what number? Very good, 30,000 because it is a uniform cash flow. While on the right side, if this is non-uniform, let's say for example, on the first year, you have, let's say, 40,000 pesos, your cash inflow. Since it is non-uniform, maybe on the second year, you have a competitive advantage, you have the growth, therefore, your cash inflow became 50K on the second year. And since the trend is increasing, maybe this one is 60,000, your cash inflow, for a duration of 3 years. So this one is a good example of a non-uniform cash flow. All right? Clear. All right. Very good. So far, so good. Let us erase the notes and let us try to get the formula for a payback period for uniform cash flow. The payback period formula is equal to the total initial capital investment which is cash outflow. That's your initial investment. So therefore, since it's an investment, it will be negative. And what is your expected annual after tax cash inflow? No? Expected annual after tax inflow. Therefore, initial investment initial investment divided by your expected initial investment divided by your annual cash inflow. However, there is a particular compliance here, and the compliance is that expected annual cash inflow should be after tax, and usually corporate tax is 30%. Okay, divided by 100 gives you 0.3. Okay, so there you go. So if you are going to calculate the payback period for a uniform cash flow, it is very imperative that it should be after tax. Okay, all right. So here on the left side, when we are talking now of this non-uniform cash flow, when cash flows are not uniform over the useful life, okay, of the asset, then the cumulative cash flow from operations must be calculated for each year, no? Cumulative, all right? In this case, the payback period shall be corresponding period where when the cumulative cash flow is equal to the initial cash outlay, meaning to say, if you see if you add your cumulative, let's say it's 30,000, the cumulative cash flow, and that is equal to the capital investment, which is, let's say, 30,000. So it is already equal, meaning to say you already somehow recovered your initial investment. Therefore, that corresponding 30,000, let's say 2 years, in 2 years time, you have already a payback. That is what is meant. Bullet number 3, in case the sum does not match, then the period in which it lies should be identified. After that, we need to compute the fraction. So, meaning to say, what are you going to learn in about the calculation? There is a fractional. Let's say if there is 30,000, there is still 30,200 for your initial investment. Therefore, this is already 30,000, the cumulative cash flow, but there's still a fraction of 200. So we need to compute that. Okay? So that is a simple layman's explanation of what is the difference between a a uh, a computation for a uniform cash flow and a computation for non-uniform cash flow. So let us proceed with a very good example. All right. So we are now discussing about uniform cash flow. Again, the formula is this one. The total initial investment expected annual cash inflow. However, it should be compliant with the government, no? That should be what? After tax. All right. So let us proceed. Okay. So here, let us try to analyze the word problem. A project cost or maybe an equipment cost of 2 million US dollars, or let's regardless of what is the currency. The, this example is in US dollar. It could be in pesos, no? Doesn't matter. Okay? It could be in pesos also, or it could be in euros. It depends. Okay? So, a project or an equipment costs 2 million and yields a profit of 30,000. So, the initial investment is 2 million. That's 2 million regardless of what currency it is. Okay? All right? And it has a profit of 30,000. Meaning to say, in with the expenditure that you made, it gained a profit of 30,000. That's your profit. Therefore, if it is a profit that is positive, this one is a negative, and this one is a cash outflow, and this one is a cash inflow. All right. So, there is a rule here that there is a depreciation of 10% straight line method, meaning to say you have to get the decimal point of that depreciation rate and multiply immediately with the total cost of the investment. All right. So here is your 30,000 cash inflow before tax, no? And then you deduct the tax, or you compute 30,000 times zero point 0.3 gives you 9,000. Okay? However, when calculating cash inflow, generally, that depreciation is added back as it does not result into cash outflow. That is correct, no? You have to include that, no, in your computation. All right. So that's 9,000. So 30,000 minus 9,000 gives you 21,000. Okay? And through straight line method of depreciation, that 200,000 came in 2 million times zero point 0.1. So it gives you 200,000. Okay. So now, your total cash inflow is 221,000. Okay? Because 200 plus 21, okay, that gives you your total cash inflow because you have to add back. Okay? All right. So therefore, you have a total cash inflow of 221. Where did you get this, Doc? 200,000 plus 21,000. So let's remove some notes. Okay, to make it clear. Okay. So therefore, uh, if you want to compute now the payback period for a uniform cash flow after tax, no, it's ready. So the total capital investment, okay, is 2 million divided by your after tax cash inflow, which is 221. Again, how did you came up with 221? This one, 21,000 plus 200,000 gives you 221,000. And this 221,000 is here. The 2 million came from this, okay, from the 2 million. All right. So, your payback is 9 years approximately. Okay? So, that is the payback period if you want to compute it with uniform cash flow. Okay, let's proceed with the non-uniform cash flow wherein we need to compute the fraction. All right? Okay, let's proceed. Okay, so here, still, the our initial capital investment is still 2 million. Okay? Same given. This is our initial capital investment or cash outflow. All right. In the first year, so this the our N here is 4 years. Why 4 years? Because first year, second, third, and fourth. This is our forecasted annual cash inflow, okay, which is on the first year 800,000, 600,000, same 600,000 and 200,000. Okay, so on the third column, you must have a cumulative annual cash inflow, meaning to say it will be added cumulatively. So, on the first year, you have 800,000. Therefore, on the second year, the cumulative is 1.4. How did you get 1.4? 800,000, this one, plus this one, gives you 1.4. But do not write this anymore. This is for the sake of how you got 1,400. Okay. Now, on the third year, what is the cumulative? Therefore, you need to add this one, 1.4, plus this one. So you have 2 million. You don't need to write this one. Okay, this is for the sake of layman's explanation. Now, what what are you going to write on the fourth column for the cumulative annual? Very good. It is 2.2. How will you compute that? Meaning to say this one plus this one gives you 200 2,000,000 200,000. Very good. So let us reduce some notes so that you can follow. All right? Okay. Now, so you can see, no? You can see that that in this third year, you can see that your cumulative cash inflow is basically equal to your initial capital investment. Therefore, the payback period is 3 years. Meaning to say, you can recover your capital investment within 3 years. Okay? Within 3 years, you are already recovered. Okay? Alright. So, that is very, very easy. Now, let's try to do another example. This time, okay, again, this is non-uniform because 800,000 is different from 600,000. Third year, it is 600,000. And the fourth year, it is 200,000. Therefore, This one is non-uniform cash flow. Okay, clear. All right. Now, let's say for example that our initial capital investment has a fraction. There is a 50,000 here. Okay? And then we will use the same annual cash inflow on this example. What only change is this one. There is a 50,000 capital. Instead of 2 million, it is 2,050,000. Right? So that we will have a typical example or a concrete example of how a fraction can be computed. All right. So here in the cumulative, you have 800,000, 1,000, 1.4, and 2 million. However, on the fourth year, you have 2.2. However, this is 50,000 only. So what is exactly, we know that within 3 years, if your capital investment is 2 million, the payback is 3 years. However, there is still a fraction here. So this one is in between 3 and 4. Now, we want to get the exact 3 years and how many months because of the 50,000. All right. So to do that, okay, so you know that this is the, in the year 3, okay, it is 2 million already. However, your initial investment is 2 million 50,000, and the third year your cumulative is 2 million. So you deduct that, you have a difference of 50,000. You remember the cash inflow in the fourth year, it is 2.2, all right? So therefore, okay, therefore that cash inflow on the third year, this one, and the cash inflow on the fourth year, you have to subtract it. So it gives you 200,000. So in 12 months, okay, in 12 months, that fraction of 50,000, you divide it by 200,000, which is this one. How did you get 200,000? The cash inflow on the fourth year minus the cash inflow on the third year gives you 200,000. So 50,000 divided by 200,000 gives you 0.25 or 1/4 year, or that is basically a quarter. So if you invested 2 million 50,000, what is the payback period? The payback period is 3 years and 3 months. That is the correct answer. You have now specific how many months? 3 years and 3 months only. You recovered 2,050,000. So if that 2 million becomes 100,000, you will recover that in 3 years and 6 months or 2.5 years. Okay? Very good. So very easy to comprehend. Now let's go to another one. The other is payback reciprocal, meaning to say the reciprocity, no? This is very easy. If you have here your project cost of or initial investment of 20,000, and it gives you on the first year uniform, no, not non-uniform, it gives you 4,000 per year profit or cash inflow. It is very easy. You just trans substitute 4,000, your cash inflow, divided by your cash outflow, times 100 gives you 20%. So what does it mean? 20% signifies the rate of return the project or investment gives every year. So this is uh, This is the rate of return, no? That the cost of the business gives you, right? That is payback reciprocal. Okay? And the last is discounted payback period. I am recommending that this is the most accurate computation of the payback period simply because you include the risk and the time value of money. That is why I like to compute payback period. I want the discounted payback period method. Why? Because it is accurate and realistic. Why? Because it includes the risk and the time value of the money. So, discounted payback period is where the cash flow are discounted before calculating the period of payback inclusive of the time value of money. And this is the most appropriate rate to discount cash flow, which is the weighted average cost of capital or the internal rate of return. On our third module, we are going to discuss about decision-making technique in business finance related to internal rate of return, which is the third technique. I will have a separate video on that. But today's lesson is about payback. Previous lesson is about net present value. All right, let us proceed. So, there is an initial investment or cash outflow of this amount, 2.324. And it generates 600,000 per year for 6 years. What is this 600,000 per year for 6 years? So, we need to say the N is 6 years and your discount rate is or I is 11%. Again, please be mindful that you have to divide this by 11 by 100 so that you will not be mistaken in your calculation. Okay, very good. All right. So, is this a uniform cash flow or non-uniform cash flow? Any raise of hands? There you go. Very good. It is a uniform cash flow because all of the duration of 6 years, you have a constant 600,000 cash inflow. All right. So let's do the discounted payback period, same computation with the net present value factor. All right, we will use the short method. Okay, you can use the long, but for this example, I executed and implemented a short method. Okay, so this is our cash outflow. That's why it is negative. There you go. Okay, because it goes out. So that is the start. That's why it is 0. How many columns? 1, 2, 3, 4, and 5. What is written on the y-axis? The number of years. You started it from 0. What are you going to write with the 0? The capital investment or the cash outflow or the initial cost of the investment. Therefore, why negative? Because it is cash outflow, going out. Okay? And the rest are positive because it is coming inside the company. Alright. That is the annual cash inflow uniform from 1st to 6th. That's why it is 600,000. What is written on the third column is the present value factor, this one. This we are now going to refer it to our present value table. Okay? And this one is the product, as of course this is 1, no, as a start. So you have this one. Okay? So on the first year, you just multiply this, multiply, multiply, and you just multiply. And if you add that, it will give you this one. That is the discounted cash flow. However, there is on the last column the cumulative discounted cash flow. So your capital investment is negative minus 540. It gives you negative 1.7. This one minus this one gives you negative 1.296. This one minus this one gives you 857 negative. This one minus this one gives you 462. And 462 minus this one is still negative. On the 6th year, it is now negative 106 minus positive 320. That's why that 214 has no more sign. No, it is already positive. Therefore, the recovery is between 5 and 6 years. But, we learn about how to compute a a payback that needs to have a fraction, no? Okay. So let's try to uh, lessen our lessen our notes. Again, I will repeat. Okay. Okay. I will repeat for the sake of knowledge. Okay. This one is negative because it is a cash outflow. This one is a start. That's why it is 1.4 decimal places, 000. Okay? Alright, so this minus this gives you this one. Okay? This minus this one gives you a difference of this one. This minus this one gives you this one. This minus this one gives you this one difference. This minus this one gives you a difference of negative 106,462. And this one minus the positive, still you have to deduct it, but the symbol is already positive. So you can see here, virtually, okay, you can see here that there is between year 5 and 6, there is already a payback. However, you need to get the exact fractional month, no? On what particular year that this one has to recover. So, our Our important thing to remember is the cumulative discounted cash flow on the 5th year, which is this value, negative 106,462. And on the discounted cash flow, on the 6th year, we have 320,75. That is on the discounted cash flow. This one, 600,000 times this factor gives you this one. Okay? All right. So, now, let us try to determine where in the universe we got this factor. And the given is 11% for 6 years. So, if we will check on the table, we are going to refer it on 11% and 6 years. Okay. So, now we are concentrated on 11%, this one, and we are concentrated on the 6th year. So therefore, all that intersection that goes to the 11% is these factors. This factor, on the 6th year, you are going to use this factor. On the 5th year, you are going to use this factor. And on the 4th year, you are going to use this factor. And on the 3rd year, you are going to use this factor. On the 2nd year, this factor. On the 1st year, this factor. Because you are uh, specifically requiring 11% and 6 years. Okay? So there you go. So let's go to the computation. Okay. So if you want to compute now that 5 years plus 106, okay, on the 5th year and divided by that remaining cumulative 320. Now, in order for you to transpose this, it has to be positive. So 106 5 plus 106,000 462 divided by 320. So it gives you 5 plus 0.33, or that is 5.33 years. So your payback period is 5.33, or basically 5 years and let's say 3 months. So there you go. Okay? So that is how you are going to compute the fraction of the months, no? Because on the 5th year, on the 6th year, you are already positive. But you want to know in what particular 5th of the year that particular investment is going to be recovered. So that is 5.33, or basically 5 years, 3 to 4 months. Okay? Now, what are the advantages? The advantage is the discounted payback period method is reliable than the simple payback, simply because it involves the time value of money and the risk of exposure. Okay, the decision making is like this: that if a project has a negative net present value, it won't pay back the initial investment. That's one, no? Of course, if it is a negative NPV, there's no payback. Simple as that. Now, the disadvantage, it ignores the cash inflow from project after the payback period. So, the decision making, an attractive project having a lower initial inflow but higher terminal cash flow should be rejected. Okay? Of course, no? Your cash inflow is lower, but you have a very high investment. So you have to improve your business model and business strategy of how you can increase your revenue and sales and control your expenses. All right? Because you must conduct a customer analysis and conduct competitor analysis so that you can improve. You better understand your customers' demographics. You have to strategize in what particular niche market you are uh, doing a revenues, and what are still the unturned market. So this is again the second technique in capital budgeting, which is called payback period. And there are uniform payback, non-uniform payback. We have also a payback reciprocal and payback using discounted cash flow method. And the discounted cash flow method is very useful. Now, uh, in the decision making, of course, if the payback is shorter, that is most recommended because you can easily recover your investment. How are you good at? Maybe you have a project number 1, project number 2, and project number 3. Okay? You know all the budget and forecasting in these different 3 projects. So, the shorter the payback period, the ideal to recommend the project and accept the project. That is the simple, because you have an apple to apple comparison of the 3. For example, this one is 3 years recovery. This one is 5 years. This one is 7 years. With, let's say, if everything is equal, meaning to say, if your capital investment is, let's say, 200,000, everything is equal, okay, for this project, okay, and definitely it will be a non-uniform cash inflow for this one, but you computed all of this, everything equal, the net present value are all positive when you compared project 1, project 2, project 3. However, in the payback, you found out that project 1, in 3 years' time, you have already the recovery of your investment. Therefore, you recommend project number 1, even though the net present value is positive, no? All of this, the NPV is positive. However, the recovery is this one. So that is the beauty of capital budgeting technique, using a combination of net present value and the payback period. Okay? So again, I want you to try to review again the video. If some of the items are unclear or in the gray areas, I will recommend you to watch again this video. You have to review so that you can grasp this module. All right, this is, I think, module number 4. All right, so always keep safe and always watch my YouTube channel. Always share this to your friends, to your relatives, especially those who are in senior high school 12, all right, or in the colleges you are studying, because my advocacy really is to provide the Filipino students, Luzon, Visayas, Mindanao, the quality education. So thank you very much and see you later in my next video.